So today is Monday, February 28th. This is the 11 a.m. section. Recording is on. So today we're going to focus primarily on what we're going to call historical analysis. This is the second section of the class. I posted lecture note 4 this morning online, an updated version. That is the file that you will need for what we're going to do during class today. So go ahead and share my browser. So in the file section, you'll need lecture note 4. Okay. In addition, I posted under HW5 the homework 5 solution to the converted statements. Okay, so we're not going to go over the conversion solution in class today. You're welcome to download it. We will go over the solution on Wednesday if everybody has any questions, or you can reach out to the office hour TAs later this week. But I just wanted to at least put the solution up there. We are today going to go to the next step, which is analyzing the converted statements, okay, which is what's in lecture note 4. Okay. And I want to mention a couple of changes of logistics here on the assignments page. The most exciting one is that on Wednesday, March 9th, Bloomberg is coming to all the sections and will be here virtually all day. Okay, so the team at Bloomberg that's coming is their university recruiting team. So they are going to do 2 things. One, 443 in particular has been a source of recruiting for Bloomberg now for a number of years. A lot of students in this class get directly recruited for either internships or full-time positions. And so the people that are doing the recruiting are going to be here all day. So if you're interested in an internship or a full-time position, these are the people to kind of connect with, right? And they're going to be telling you about Bloomberg. But most importantly, they're going to be here to do advanced user training. Okay, so these people also are going to spend a lot of time explaining to you how to use other aspects of the terminal and answering some questions about its usage. They're going to be here, have the whole day, all sections. So we want to represent well. So attendance is obviously mandatory, but otherwise Wednesday, March 9th, Bloomberg guest lecturing all sections all day. Now that does move the midterm exam. So the midterm exam was originally scheduled for March 9th. So the midterm exam has been shifted to Monday, March 14th. Okay, so new date for the midterm exam in class, Monday, March 14th. Okay, and then Wednesday, March 16th, just as an update, you'll be doing your second group project presentation on the group project historical analysis. Okay, so that's going to be coming up very quickly, and that'll be basically on content that we're going to be covering in class today. Okay, that'll be your second group project, 10-minute presentation, similar to the ones you did last week. And by the way, thank you for submitting the peer reviews. We will apply the peer reviews the next couple of days. If everybody has their grades adjusted, the adjustments will come this week. And essentially, as I said, we'll start working on grading homework 5. Homework 5 solution is online. Homework 6 will be due next Monday, which will again cover the historical statements we're doing in class today. So a few logistics while you got your PowerPoint ready. So let me share my screen and go to lecture note 4.
For the midterm exam, what should we expect? Like, what's the format of the exam going to be?
Great question. So the midterm exam is going to be an open book, open notes. Obviously, you'll need a computer, but basically the midterm exam is primarily just going to be an economic statement conversion. So I'll give you economic statements. You have to individually convert them. The only difference is you'll have 90 minutes to do it. So later this week, I will also post some additional practice economic statement conversions. As opposed to right after the midterm exam, you'll be explaining verbally as part of your group project how to analyze those converted statements.
So kind of like what we just did for the homework.
Very much a repeat of homework 5.
Okay, thank you.
No, great question. And I forgot to pause to ask questions. Any other questions?
I had a question. When you say in class, does that mean we need to be on Zoom during the midterm, the 90-minute midterm?
You don't have to be on Zoom, excuse me, but you will take the midterm during class time.
Okay.
So your midterm will be available between 11 a.m. and 12:30 p.m. So if you're registered for this class, you take it during your class time. If you happen to be visiting this class and you're on another section, you'll take it during the time that you're registered for on ELMS. Great question. Other questions? All right, so back to the lecture notes. Lecture note 4, historical analysis, second section of the class. There are 2 types of historical analysis that we are going to do. Now, the past doesn't guarantee the future, but the past helps us understand and forecast the future. That's the premise. So one of the past statements we're going to look at is something we're going to call the ROIC tree. This will break down the drivers of ROIC. And there will be 2 levels of analysis that we'll do when we break down and analyze ROIC. Something called the first level drivers. ROIC is always a function of 3 things, same things repeatedly: tax rate, operating margin, productivity. So the first thing we're going to do is explain how those 3 drivers explain the changes in ROIC over time. Second level drivers analysis will be, okay, operating margins, one of the drivers, operating margins, a function of the income statement. What are the items in the income statement, gross margin, SG&A, and depreciation, that explain the changes in the operating margin? Productivity is coming from the balance sheet. What are the drivers of productivity in the balance sheet? Changes in working capital, PP&E, and intangibles. Those become the drivers of productivity from the balance sheet. Okay, so first level drivers, second level drivers, explain all of that in an ROIC tree. We'll also analyze a second statement, which is the CFI. Your directly converted CFI, you will need to explain. That statement has 4 buckets or 4 boxes: operating cash flow, non-operating cash flow, which equals CFI. That equals the funds flow, the debt, and the equity flows. So you will explain what's going on with the cash flow in each one of those 4 boxes. What's driving free cash flow? Gross cash flow reinvestment. What's driving non-operating cash flow? Primarily spending on excess cash and non-operating assets. What's driving debt flows? Interest, change in debt. What's driving equity flows? Any share repurchase or dividends, stock issue or repurchase. So those things are the primary items that you're going to be explaining when you explain the changes in CFI. And that's what we're going to cover in class today, including a chance to give you as teams to work on this explanation and analysis yourselves. All right, so let's start out with the ROIC tree. And we're going to start out with Starbucks as our in-class example. And specifically, we're going to start out with explaining the EOY, or what's known as the end of year ROIC for Starbucks. Okay, so EOY as opposed to BOY, end of year, means current year no plat divided by current year invested capital. And there's 5 years worth of historical data on this tree going from 2017 to 2021. Now, for purposes of the in-class analysis today, we're just going to do the beginning and the end, 2017 and 2021, and the changes over the 5 years. However, when you do your homework, when you do your midterm exam, you will also be responsible for the intermediate years. Okay, so in class example today, training wheels on, I'm just going to focus on the beginning and the end. When you do your assignment, when you do your group project presentation, you're going to be responsible for the middle years as well. In addition, when you do your projects, you're going to be responsible for telling me what's actually happening to the company. So for example, if there's a giant spike in invested capital to sales here in 2020 from 2019, between those 2 years, you got to explain what happened in the real world that causes that. Okay. If there's a big increase in intangibles between 2017 and 2018, suggesting that Starbucks bought somebody, you got to tell me who they bought. right? If you don't relate this to the real world, there will be massive deductions in your grade. You can't just plug and chug your way through this analysis in this class. All right, so back to this analysis. Again, let's start with the trading wheels up. Why did, so this is where we're going to start. Why did the ROIC go from 48.3% to 23.2% over the last 5 years for Starbucks? That was, and this is a 5-year percentage change, a 51.9% drop over 5 years in their ROIC. There are 3 reasons that ROIC changes. Always 3 reasons. 1, tax rate. This is 1. 2, operating margin. 3, invested capital to sales. So using those 3 numbers, we knew it to explain why that end of year ROIC went from 48.3 to 23.2. Okay. The first one is the tax rate. In 2017, Starbucks tax rate was 33.2%. In 2021, their tax rate fell to 21.6%. That's a 35% decline in the tax rate. So if Starbucks is paying less in taxes, 33.2 versus 21.6, that should help the ROIC. So this should be improving the ROIC, not hurting the ROIC. It's supposed to be an up arrow. That should be improving the ROIC. It's not. Okay. So the real reason why the ROIC went down from 2007 to 2021 is because the pre-tax ROIC went down. It went from 72.3% to 29.6%. So that 59% drop in their underlying business is what happened to Starbucks. What caused this pre-tax ROIC to go down? This is where drivers 2 and 3 come in. So just as a reminder, we are trying to solve for return on investment, which algebraically is just profit over investment. That's return on invested capital, right? Margin, which is driver number 2, is basically profit divided by sales or revenue. Okay, so P over S, right? Return on investment is P over I. So the question is, how do you get from P over S to P over I? This is driver number 3. So algebraically, we know that we would multiply this by S over I. The S's cancel out, and that will equal P over I. Okay, so this algebraic expression tells me there are 2 drivers of equal weight. That's what that multiplication sign says, that drive return on investment. P over S, also known as margin, profit divided by sales, profit margin or operating margin, times sales over investment, which is what we're going to call productivity or efficiency, equals return on investment. Okay, so start out with operating margin and then invested capital sales. Now, in this ratio over here, driver 3 is invested capital over sales. In this ratio down here, it's sales relative to investment. So the difference here is we're taking the reciprocal, I over S. Here, it's S over I. Okay. Now, you might say, why am I taking reciprocal over here? And the answer is twofold. 1, companies tend to think in terms of dollars of sales. Investors tend to think in terms of dollars of investment, meaning how much profit do I make when I generate $1 of sales? That's margin. How much do I invest to generate that $1 of sales? That's investment divided by sales. That's the reciprocal. How do investors think? I give you money, investment, how much profit do you make? Return on investment. Notice investors don't care about sales, right? But internally, we tend to care about sales. So I'm denominating everything in sales. So this is just a reciprocal here, which is driver number 3. The other reason why I took the reciprocal is this entire tree is per $1 of sales. And by making the entire tree per $1 of sales, things are additive across the columns, okay, which we'll see is going to be very important when we do the second level of sales. All right. So with that in mind, let's talk about operating margin. Again, reminding ourselves, pre-tax ROIC went from 72.3 to 29.6. Why? Well, operating margin went from 18.5 cents to 16.8 cents over that 5 years. That was a 9.2% drop in operating or EBIT margin, EBIT divided by sales, right? So Starbucks makes less every time they sell a cup of coffee. Specifically, they're making 1.7 cents per dollar less. Okay. Now, secondly, invested capital to sales went from 25.5 to 56.6. Let's talk about what that means. In 2017, to generate $1 of sales, Starbucks invested 25 cents. In 2021, to sell $1 of sales, Starbucks invested 57 cents, 56.6. That's a 121.6% increase in the investment required to generate $1 of sales. That is far worse productivity. Both of these drivers, 2 and 3, negatively impacted ROIC. Okay, so if you really think about this, the operating margin fell by 9% from 18.5 to 16.8, and the productivity worsened by 122% from 25.5 to 56.6. The combined lowering of both from an ROIC standpoint hurt the pre-tax ROIC. But the one that hurt it more was the doubling of the invested capital to sales. That had a far bigger impact on the reduction of pre-tax ROIC from Starbucks going from 72 to 29.6. That is what we would call the first level drivers. Questions about the first level drivers? Second level drivers. What explains the drop in operating margin? That's driven by the income statement. So over here on the right, these are the 3 drivers of operating margin from the income statement. Gross margin minus SG&A minus depreciation as a percentage of sales equals operating margin as a percentage of sales. So those 3 things on the right explain this column. Okay, so when you think about that, over here, gross margin minus SG&A minus depreciation equals operating margin. So these 3 things explain this, right? So why did the operating margin go from 18.5 to 16.8? Well, first of all, the gross margin went from 35.3 to 34.1. That was a 3.3% decline in the gross margin, right? So gross margin went down by basically 1.2 cents, 1.2 percentage points. SG&A went from 13.8 to 13.4. That's a 2.7% decline. Now, a reduction in SG&A should actually help the operating margin. So that improved the operating margin by 0.004. Depreciation as a percentage of sales went from 4.8 to 5.2. That was a worsening 0.04. That was a 10% worsening. But you got to be careful here, because even though this is percentage change, 10% on a smaller number is not as impactful as 3% on a bigger number. So when you really look at what's driving the operating margin here, this 1.2 cent drop in gross margin was far more impactful than the 0.004 rise of depreciation, benefited by a 0.004 reduction in SG&A. But the primary reason the operating margin went down, 18.5 to 16.8, was the drop in the gross margin. That's what we know in the second level driver for the income statement. Questions about any of that? Next, we'll do the second level driver for the balance sheet. Balance sheet is invested capital, or rearranged balance sheet, or TFI. The balance sheet has 3 primary drivers of invested capital. The first, operating working capital. The second, PP&E, property, plant, and equipment. That's the stores for Starbucks. Third, intangibles. Intangibles occur when a company purchases the intangibles, translate goodwill from somebody else. Okay, so working capital plus PP&E to sales plus intangibles to sales. You add these three things up, you get equals invested capital to sales. All right, so that invested capital sales is those three things added up. So those are the three parts of invested capital. So let's go back and analyze those. So working capital went from -5 cents 2017 to -7.5 cents in 2021. Okay, that's a 42% increase in the working capital, but it went more negative. The way that you have negative working capital is you have more liabilities than assets. Okay, so more negative working capital means even more liabilities relative to your assets. That reduces invested capital. Okay, so they go from -5 to -7.5. This is going to be helping their invested capital go down. That's not why their invested capital doubled. The next item is spending on stores, PP&E to sales. In 2017, they spent 22 cents on PP&E for every dollar of sales. In 2021, they spent 50 cents on PP&E for every dollar of sales. They more than doubled the amount of spending on their stores, right? That's the big reason why invested capital sales went from 25.5 to 56 cents. The third factor is spending on intangibles. In 2017, they spent 8.8 cents on intangibles per dollar of sales. In 2021, they spent 13.9 cents per dollar on sales. That's a 56.6% increase. So spent a lot more in acquisitions. Matter of fact, you can see clearly here, as I highlighted earlier, between 2017 and 2018, big jump in intangibles, big purchase by Starbucks of somebody. Who did they buy? I would expect you to know that. Okay. But for purposes of this intro, 8.8 to 13.9. Okay. So a big jump in intangibles. But if we look at it, the primary reason invested capital sales went up was PP&E going from 22 to 50. We go from left to right in our analysis as we go through the first and the second levels. Once we've completed the second level, we then summarize by going right to left. So the summary for Starbucks is a decline in gross margin from 35.3 to 34.1. Hurt Starbucks operating margin from 18.5 to 16.8, primarily. But the real driver of the pre-tax ROIC going down was the worsening of invested capital sales, which is driven primarily by the PP&E to sales going from 22 to 53, which drove invested capital sales primarily from 25.5 to 56.6, which primarily drove the pre-tax ROIC down from 72.3 to 29.6. That was offset by a slight improvement in the tax rate from 33 to 22, which led the overall ROIC of Starbucks after tax to go from 48% to 23.2. That is your analysis. That's what you're going to have to do in your minimum 500 word papers individually for your next homework assignment. That is what you're going to have to do in your 10-minute presentation when you do your presentation for the group projects. Questions about the ROIC tree walkthrough?
I have a question, Professor.
Yes. Go ahead.
On the bottom right-hand side, I mean, couldn't you just look at that and just say their sales are declining for all of them? Wouldn't that explain all three of those, that the operating working capital is going down because their sales are going down?
Well, since everything is a percentage of sales, that could be why this is happening. So again, on this page, we don't have the sales, but I think it's a good dot to connect, because obviously if you have less sales and you have the same amount of stores, then your PP&E as a percentage of sales goes up dramatically. So back to the insight about why this is happening. This is why I go back to, this is a great question because it shows the real world context that you're already starting to link to about what's happening to Starbucks. So really good insight in that question. Other questions about this? All right. So we'll do another company. just to practice. I'll go through this one in a minute. You're going to be practicing yourselves. So we'll go through target. What happened to target over this 5-year period from 2017 to 2021? So their ROIC went from 13.5% to 25.5% over this 5-year period of time, a 52% increase in their ROIC after tax. Looking at the first driver of tax rate, tax rate went from 32.7 to 21.2. That was a 35% decline in Target's tax rate. In addition, so that should have helped their ROIC. It did. Okay. So unlike Starbucks, the tax rate also was one of the direct drivers that you saw the increase in the after-tax ROIC. They also were helped by the pre-tax ROIC going from 20% to 26%, a 29.9% increase. Why'd the pre-tax situation, why'd the operations get better? Drivers 2 and 3, margin and productivity. Margin at Target went from 7.2 cents to 7%. Their margin went down by 2.3 cents. That did not help their pre-tax ROIC. That would have hurt their pre-tax ROIC. So the entire improvement in pre-tax ROIC was productivity. Invested capital to sales going from 35.7 to 26.8, a 24.8% improvement in invested capital to sales. That's why their pre-tax ROIC went down. All of it. Okay. That's what we finished with the first level analysis. Second level analysis. Why'd the margin go from 7 to 7.2? Well, their gross margin went from 32.6 to 31.9, went down by 0.007. Okay. Their SG&A went from 22.1 to 22.3. It barely went up by 0.002. So really the operating margin was the decline in the gross margin. And depreciation went from 3.3 to 2.7. That would have benefited the operating margin, 3.3 to 2.7. So basically they saved 0.6% here in depreciation. They spent 0.002 cents on SG&A. So really the operating margin was the decline of the gross margin, 32.6 to 31.9. Invested capital to sales was the big mover, 35.7 to 26.8. Why? On the balance sheet, working capital went from 0 to 0.05 negative. So 5 cents per dollar more of liabilities relative to assets and working capital. That's half of the invested capital to sales drop. The other half is PP&E to sales, which went from 35.5 to 31.1. So they got 4.4 cents here in PP&E. They got 5 cents here in working capital. Those together were really this 35.8 minus 26.8. That was the 9 cents of invested capital to sales improvement. Intangible to sales, close to zero, close to zero. Unlike Starbucks, Target doesn't do a lot of acquisitions. Okay, they don't really have an increase in intangibles. So for them, it's all about working capital and PP&E. Those improvements in both of those led to big improvements in invested capital to sales over the 5 years. So moving and summarizing right to left, we can see primarily the drop in gross margin from 32.6 to 31.9 led to the drop in the operating margin from 7.2 to 7, and a combination of improvement in working capital and store productivity of PP&E led to the drop in the invested capital to sales, 35.7 to 26.8. And it was that invested capital to sales dropping, which led to the pre-tax ROIC going from 20 to 26, combined with a tax rate improvement from 33 to 21, which led the after-tax ROIC to go from 13.5 to 20.5. That's the summary once we've done the analytics. That's what you have to cover using numbers when you do the ROIC tree walkthrough. Questions about Target? All right. Well, if no questions about Target ROIC tree, let's talk about the other statement, which is the CFI. As I mentioned in the introductions today, we're going to cover all 4 sections of the converted CFI when we explain it. So let's start out with Starbucks CFI. So as I mentioned, yeah, go ahead. Somebody raise their hand.
Yeah, quick question about the tree. Do we make that for our individual company on Excel?
Yes and no. So for your assignments before the midterm, I'm going to give you the trees. So I'll give you the tree for the in-class assignment you'll do on Wednesday. I'll give you the tree for homework 6. I'll give you the trees that you'll work on for your group projects.
Okay.
After the midterm, we are going to build an Excel model that will value companies. That Excel model will create these trees. So you're going to actually create your own trees in the future for future assignments. But as we start to do the analysis, I will give you the trees.
Okay, thank you.
Sure. Same thing. I'll give you the CFIs as well. After the midterm, when you do the valuations, you'll create your own CFIs for the analytics, right? So this is Starbucks CFI, 5 years worth of CFI, and then a total column, which just literally adds up the 5 years. That's what the total column does. So back to the analytics. Again, for purposes of today, in the training wheels, as I explain the statements and how we analyze it, I'm just going to give you the total. We're just going to go through the total column. So that will be this column. When you do your assignments and when you do your group project, you're going to be responsible for the intervening years as well. And just like the ROIC tree, if there's a big change in here, you better darn well explain it when with the real world, what's going on. Okay, so you can't just plug and chug. But as we introduce the structure of the analysis, we'll start here. So where you actually start in the CFI is specifically right here with free cash flow. And how the free cash flow is represented will be telling as to how you do the analysis of the statement. So for example, if free cash flow is positive, so over the 5 years, it was $3,235.8 million. Then your analysis is what did the company do with the cash? So the rest of the sections of the TFI or sorry, CFI should be where the 3.2 billion gets spent. If the CFI is negative, for example, in 2020, it was negative 8.5 billion. That means they spent more cash than they made. Well, where did they fund that negative cash flow? So the rest of the statements should be where did the money come from? Okay. So when we start analyzing the CFI, we start with free cash flow, and whether or not it's positive or negative will determine how we do the rest of our analysis. For purposes of Starbucks, since they generated 3.2 billion of positive cash flow over the 5 years, then how they generate 3.2 billion and where did the cash go is how we're going to start our analysis. So how they generate 3.2 billion? Well, gross cash flow was 20,990.2 million. That's cash coming from the income statement. Gross investments was 15.963 billion. They put 15.96 billion back into the balance sheet. That led to free cash flow before acquisitions of 5,027 million. Goodwill is part of purchase price premiums are part of reinvestment. So, but we just break it out here. Spent 1,791 million on goodwill, leading to 3.2 billion of overall positive free cash flow. Right? But I want you to directly understand that there's 3 drivers on here of reinvestment. 1, working capital. 2, CapEx. 3, spending on goodwill. Those 3 drivers are basically the same as the ROIC tree, these 3 drivers. Working capital, CapEx, which drives PP&E, intangibles, and goodwill, which drives intangibles to sales. So this is how you start to link back to the tree. So 2 drivers of gross investment, working capital, PP&E, Okay, that's CapEx. And then the third driver is goodwill. Okay, but these are the reinvestments of the 29.99 billion, leading to 3.2 billion of free cash flow. Said a different way, 15.9 billion is 76% of 20 billion 990. So their reinvestment rate, or investment rate as it's called, 76%. They're putting 76 cents at every dollar. But notice it wasn't 76% every year. Some years it was low, 6%. Some years it was high, 416%. So different levels of reinvestment over time averaged out to 76%. The other key number here is this ratio of CapEx to depreciation. Okay. We know that depreciation, straight line, basically represents the amount of assets that are wearing out each year. It's technically what depreciation is. And my assets are going to not last forever. So I say how much of the asset is basically used up each period, straight line averages over time. Okay. So assuming that, there's another assumption we make. I have to spend my depreciation to kind of tread water, right? Because if I'm losing a certain percentage of my business through depreciation, I got to make up for it to kind of keep my assets in the current state. Okay. So an assumption in finance is companies respend depreciation to basically maintain current level of sales, current level of assets, okay? Current level PP&E. Now here's the thing. If a company spends more on CapEx than what is wearing out, more CapEx than depreciation, that's a growth signal. Why would I want to add more PP&E if I didn't think that I wasn't going to go sell more stuff? The opposite is true. If my CapEx is less than my depreciation, that is a slowing of sales signal. I don't want to add a bunch of stores if I don't think I'm actually going to get the customers to come in and be in those stores. So I'm not going to spend a lot of CapEx if I don't fund growth. So sitting here in plain sight, there is a ratio that's kind of telling you what management thinks about the growth prospects. Because if they're spending a lot more on CapEx than depreciation, they're signaling they expect to grow. If they're spending a lot less than CapEx than depreciation, they're signaling they're not expecting to grow. If they spend about their depreciation, then they're basically saying their growth is not going to be that strong. It's going to be tepid. They're going to basically maintain. Now, obviously, excess capacity applies to this. But the point here is let's look at what's going on with Starbucks over time. All 5 years, they spent more on CapEx than depreciation, particularly in 2020, where it went up dramatically. Again, back to the real world. Why did it go up dramatically in 2020? You should be able to explain that. But 2021, all 5 years, CapEx higher than depreciation would suggest a growth, although it slowed in 2021. 2021, the lowest year of CapEx depreciation, which means probably slowing growth prospects, okay, in 2022. That's what they're kind of telling us right here in plain sight. Make sense? Questions about that? All right, well then continuing on with Starbucks. So we know they generated $3.2 billion worth of free cash flow. So the question then becomes, okay, how did this turn into their CFI of $8.5 billion? Well, that meant to get from 3.2 to 8.5, they had to generate non-operating cash flow. Three big items are moving here. They generated $6.3 billion worth of cash by basically selling non-operating assets. They generated $3.2 billion worth of cash from non-operating gains on their income statement. And they also put $4.2 billion worth of cash in the bank, increasing their excess cash reserves. But net, $5 billion of extra dollars of cash went to CFI, and they had $8.5 billion to distribute. Now we go to the funds flow part of the CFI. What did they do with the $8.5 billion? How did they give it to the debt and equity holders? For the debt holders, they paid $1.176 billion worth of interest expense. Negative 20,000.2 means they borrowed $20 billion worth of new debt. This has been a recurring exam question on the final exam and every now and then on the midterm exam. did Starbucks need to borrow the $20 billion worth of debt? Or was this discretionary? There's actually an answer to that question. And I'll ask, how would you know? By looking at this statement. Was this necessary or discretionary debt issuance? Question to this group. Necessary or discretionary? They need to borrow the 20 billion or not? And how do you know?
I have an answer. I
Oh,
think,
go ahead.
yeah, they essentially borrow the money and repurchase shares with it. And
All right, you're jumping one step ahead. Absolutely. That's what they did with the cash. But going back to, was it necessary? Did they need to borrow $20 billion to fund their operations?
no,
Why do we know they didn't need to borrow 20 billion to fund their operations?
because they generated $8.5 billion.
Of CFI and 3.2 billion of free cash flow. Exactly. So if you're generating free cash flow, you're generating more cash than you spend from your operations. You don't need to borrow money. So back to Peter's point, I think it was Peter who just said that. This was discretionary debt. Why did they borrow it? It's going to become very clear in a second. Going to the equity cash flows. They paid out almost $9 billion in dividends over the 5 years, 89.97.6. They bought back $21.5 billion worth of shares. So how do you pay back $21.5 billion worth of shares if you don't have any cash left? $20 billion worth of debt was $21 billion worth of share repurchase. It's right there in black and white. Because basically all the CFI went out in dividends. So what did Starbucks basically do with all their cash? They gave it to the shareholders. Matter of fact, they gave more than they made to the shareholders, and they borrowed a bunch of money to do it. Now, this has been pretty common in the last few years because we've had all-time low net interest rates. And what companies have been doing is they've been taking advantage of these very low interest rates to basically issue debt to buy back shares. But I'm telling you, that's not sustainable. Because what is a sustainable payout is the free cash flow. That's your sustainable payout. Anything above that is just what the banks are willing to let you do. And the banks are going to keep letting Starbucks borrow 20 billion if they make 3 on a long-term basis. So if I'm an investor, I look at the share repurchase. Don't get me wrong. I like to have cash. It's great. I get cash in my pocket. But this isn't cash because the business is doing better. This is cash because Starbucks is borrowing a lot of money to give it to me. So I'm not going to give them as much credit for that share repurchase as if their free cash flow was $23 billion. And then they gave me 21 billion of that as share repurchase. That's a sustainable share repurchase. 3 billion in free cash flow doesn't sustain 21 billion of stock repurchase. That is short term. Okay. Now you might also ask, why would companies do that? Another reason is a lot of management team and CEO bonuses are tied for public companies to increasing the EPS. Increase EPS, increase my bonus. Buying back shares drives up EPS at a faster rate. Kind of win-win for everybody. Okay. So the rules of the game are actually set up to encourage stock buybacks. Right. But all that aside, this is what Starbucks did over the 5 years. Questions about their CFI? All right, one more example. Let's look at Target CFI. 4 sections, as I said, we start out with free cash flow. Target's free cash flow was $18.9 billion. Why was it $18.9 billion? Because they generated $31.1 billion of gross cash flow, and they reinvested $11.8 billion back in the balance sheet, an overall rate of reinvestment of 38%. They had negative $4.4 billion of working capital, $16.2 billion of CapEx. So that's how they got to the $11.8 billion of gross investment. Starbucks spent a trivial amount on acquisitions, $390 million, getting $19.3 billion, became $18.9 billion of overall free cash flow. And Starbucks investment rate was between 33% and 9%, per year over the last 5 years. And we can see that in 2017, their ratio of CapEx to depreciation was only 76%. So in 2017, they weren't expecting to grow. 2018, 19, 20, and 21, they spent more than 100% CapEx to depreciation. All started to slow in 2021 slightly, but they averaged 132% over the last 5 years. So they have been signaling pretty consistent growth, particularly for the last 4 years. Okay. And that would be expected to continue into 2022. 18.9 billion of free cash flow turned into 15.1 billion of CFI. Why? Well, mainly because they put $4 billion into increasing their excess cash. So that 4.1 billion, 4069.5 of increase in excess cash is the primary reason they only had 15.1 billion to actually distribute a CFI. How did they distribute it? 2.7 billion was paid out in interest. They borrowed $2.3 billion of debt, a little bit of debt that they didn't need compared to Starbucks' giant debt issue. They paid out $6.6 billion worth of dividends, bought back $9.2 billion worth of stock. 6.6 and 9.2 is basically $16 billion worth of cash returned to shareholders. 15 billion of CFI and 2 billion of debt got me the $16 billion that I gave to the shareholders. But mostly Target's cash to the shareholders primarily came from the CFI, and all of that cash was free cash flow. So I'm going to look at Target's share repurchase slightly differently than Starbucks. Starbucks borrowed a bunch of money to basically pay back the shareholders. Target earned the money and then gave it to shareholders. Their repurchase and dividends are more sustainable. Okay? Target, Starbucks, CFI analysis, 4 sections, questions. Questions about any of this? All right, on the next 2 slides, you have Walmart, CFI, ROIC tree. What I'm going to do is I'm going to put you into breakout teams. I'm going to give you the ability to share your screen. So you have one person share, all the people on the team analyze it. When we come back from the breakouts, I'm going to either get volunteers that are going to walk through this analysis, or I'm going to call on you. And if you don't answer, I'm going to drop you from the class. I will knock you out of Zoom. And also that will ruin your attendance or your ability to opt out of your final exam. So they didn't believe me in the last class. I did it. So I'm just giving you a warning right now that when I ask people to analyze things in class and I don't hear from you, I'm going to start calling on people. And if you don't answer, you're getting booted out of class. So I'm going to put you into breakout teams. When we come back in 10 minutes, you're going to explain to me the Walmart ROIC tree and the Walmart CFI as practice. Right? So I'm going to open up the Zoom rooms. I'm going to put you into essentially 8 teams. And we'll be back in 10 minutes. See everybody in 10 minutes. All right. Let me share my screen again for Walmart. So let's start out with the Walmart ROIC. Do I have a volunteer to walk through this? First level analysis, what I'm interested in. Walmart ROIC.
We can walk through it.
All right. I don't know who the we is. Can you identify yourself and start going?
Yes, Eric.
All right, Eric,
And
thank you.
we talked about the decrease in ROIC. We attributed that primarily to the decrease in pre-tax ROIC, which in looking at the operating margin, that fell 21.5%. And the largest change in the operating margin would be the gross margin declining -1% from.
Hold on, we're not going to second level. We're just on the first level.
Oh, sorry.
It's okay.
So, yeah, so we thought that because the operating margin decreased -21.5%, that was driving the decline in the pre-tax ROIC, while the cash tax rate declined, which would theoretically have helped it.
Great. So I think directionally, you are connecting the dots, which is wonderful. But just to kind of help everybody understand what you're talking about in the required class, what did the pre-tax ROIC go down from to?
From 18.4 to 14.1.
And the operating margin went down from to,
0.050 to 0.039.
and that's the reason why the pre-tax ROIC went down from 18.4 to 14.1. So I need you to use numbers. Two reasons. One, again, it should become very obvious. When you're looking at this and you're making these connections, there's 44 other people on this call that don't always know what you're talking about. Because you're looking at the number that you're talking about, but if you don't use the numbers, I don't know what number you're talking about listening to you. So I can't connect that dot. That's what's true in the real world. That's one of the reasons why I push this, because so many finance people underestimate how bad it makes you look when you don't use numbers in a real world presentation, when there's a lot of data on the screen, because nobody can figure out what the hell you're talking about, even though you know what you're talking about. But for purposes of your grade, if you don't use numbers, I will penalize your grade. Okay, that happened on your EIC presentations. It's going to happen here on future presentations. You have to use numbers, got to get in practice. So again, Eric, your team made the right connections to why the ROIC for Walmart was falling. That the after-tax went from 12.8 to 10.6 because the pre-tax went from 18.4 to 14 because the operating margin went from 5 to 3.9. You made that direct connection. So again, thank you for connecting those dots in the first level analysis with basically relatively flat invested capital to sales and a tax rate, which should have helped them going from 30.3 to 24.4. Okay. What's going on? Second level margin. Why is the margin going from 5 to 3.9? Somebody else go through the explanation of the second level drop in margin on the P&L.
We can do it. I mean, I can do it.
Go ahead.
So the gross margin decreased from 0.271 to 0.268, which is decreased 1.1%, and SGA increased 32.8% from 0.201 to 0.208, and depreciation increased 6.9% from 0.02 to 0.021. So although depreciation increased, the biggest percent, but because this that number is pretty small, so I don't think that impact a lot on the operating margin. But because we think both gross margin and SGA impact more than the depreciation on the operation margin from 0.05 to 0.03. So
Great.
yeah.
Yeah, go ahead. I didn't mean to cut you off. Go ahead.
I just said because decrease in gross margin and increase in SGA, which affect a lot for the operation margin.
Okay.
You want I go to the investment capital, or do you want to switch?
I will tell you, you're doing a great job. So keep on going.
Okay,
So
so the working capital per sales also increased from negative 0.005 to 0.023, and PP&E also increased from 0.242 to 0.242, which is 0.3%. And intangible also increased from 0.035 to 0.059, which is 71.3%. I mean, all of them increase. That's why it affects the investment capital, but because the intangible is just a small number, so the working capital and PP&E will be the biggest reason why increase investment capital.
You were doing so well in the income statement, almost. You got to be careful about the signs. So that working capital went from 0.05 negative to 0.23 negative. So more negative working capital actually should help invested capital to sales. It means lower invested capital to sales. So that's not why it went up. Actually, the PP&E being flat and the working capital to sales being more negative, that should be driving it down. The real reason the intangible invested capital to sales went up is because of intangibles. It went from 3.5 to 5.9. So I think you were almost correct because you were looking at the number 005 to 023 and thinking, oh, that's an increase, but that parentheses around it means it went more negative. And so a more negative working capital means less invested capital. But otherwise, really good insights. And you had the operating margin analysis spot on, and you used numbers, which made it really easy to follow. So overall, well done. Questions about Walmart's ROIC?
I have a question.
Yes.
For the PP&E to sales, that one, it says it increased by 0.3%, but the number from 2016 to 2020 is the same.
Yeah, that's just rounding. And the reason why is because I think somebody asked at the beginning of this class, these are created by the Excel valuation models. And
Mhm.
so we're looking at actual numbers in Excel when I calculate the percentage change, not just the 0.242. So 0.242 is rounding off. It's
Okay.
not 0.242. It's like 0.24 XXXXX. And so
Oh.
Excel is actually calculating a slight increase, but good question. So, but overall, basically flat. So I think you could say that, but that's why it's 0.03. It's not exactly flat.
Okay, and then for operating working capital to sales, if that number, you mentioned how it is actually decreasing because it's getting more negative, why is the percentage of, can you just explain like the math of how the percentage is for near 400%?
Well, going from essentially 0.005 to 0.023, I mean, going from 5 to 23, that's a 400% increase.
It wouldn't be a negative it wouldn't be a 400% decrease.
Well, since you're already in a negative to a negative, it's just a bigger negative. I don't know, I guess you could call it a negative decrease, but it's a 307% change.
Okay, got it.
I'm not, that one I won't quibble about. Because again, I also go back to magnitude. Like, as much as that looks like a big scary number, because we're going from 0.005 to 0.02, like that's actually not even as impactful as the intangibles going from 3.5 to 5.9. So again, you got to be careful about these percentages. It's literally just percent change, right? But nonetheless, yeah, you could call it a negative increase per se, just go from one negative to a bigger negative, but that's a 387% by the math. Somebody else had their hand, Weston?
Yeah, so is an increase in intangibles just mean that that company is acquiring another company, or is there anything else that could influence it?
Any purchase of intangible assets will show up on the balance sheet. So they could be buying part of another company, they could be buying assets from another company. But the point is, intangibles come between the difference between the price paid and the value of the assets acquired. And typically it's goodwill.
Okay, thank you.
Yep. All right, in the interest of time, let's quickly go to CFI. Anybody want to take their attempt at CFI for Walmart?
Yeah, I can go.
Great.
It's Rachel, by the way. So one thing that we looked at was the investment rate, or I guess the reinvestment rate. And something that really stood out was in 2020, it was 94%. And this is an obvious jump from even just the previous year of 32%. But of course, looking further back, 2016 at 28%. And this could be tied to Walmart perhaps trying to grow and expand, which would also be linked back to their increase in intangibles that was previously mentioned on the tree.
All right, since you focused on 2020 for a second, this is back to connecting some dots to the real world. They spent $26 billion on capital expenditures in 2020, right? So the big jump in reinvestment. What do you think they spent it on? Does anybody know why Walmart spent so much reinvestment, particularly CapEx in 2020?
Investing in e-commerce and online things of that nature.
Yes, Walmart Plus. So you can see all that spending was directly related to their setting up Walmart Plus and all their online e-commerce, right? It showed up in their financials, right? They even told Wall Street that they were going to spend the money to go do this. So again, it was right here in the CFI. So good call out on noticing the change, but this is what I mean by relating it back to the real world, right? So if we look at Walmart though, again, the analysis should have started at free cash flow. They generated 64.4 billion of free cash flow. 127.9 billion in gross cash flow, 50.5 billion in gross investment, 39% reinvestment rate, 13 billion spent in acquisitions. When did they do their big acquisition? What year?
I think it was 2019.
Who'd they buy?
I don't know.
That would be another one. I think it was like Bonobos or something like that. But the point is, some of their e-commerce acquisitions showed up in 2019 that they made. So again, you can kind of go through and look at, you know, what Walmart was doing. They also bought another e-commerce company whose name I forgot. And they kind of changed the name, but to compete with Amazon. But you can directly start to relate some of their acquisition spend to right here, right? Now, non-operating cash flow, 64.4 billion went to 48. Walmart had two things, 10.8 billion non-operating assets, $6 billion non-operating loss. Okay. We also see that Walmart borrowed $26 billion worth of debt, $8.5 billion worth of interest. But why they borrowed $26 billion of debt? Because they spent $65 billion in dividends and share repurchase. 31 billion in dividends, 34 billion in share repurchase. That's why they borrowed 26 billion on top of their 48 billion of CFI. So again, Walmart using the cash to return the money to shareholders, very similar to Target and Starbucks over the last 5 years. Story of the CFI. When we come back on Wednesday, I'm going to give you more time to practice in groups on these analysis. These will be your homework 6, which will be the write-up analysis that you'll do of this individually for companies that I'll give you these 2 analysis on. And then in a few weeks, you'll do your second group project presentation, same way you're doing it here in class with PowerPoints on these trees. Okay? And I'll give you the company to do it on. So that's what's coming up. Thanks for your time today. Obviously, in your Bloomberg Trading Challenge, a lot of scary stuff going on in Ukraine, right? And the surrounding world. It is completely upending the financial markets, as well as some horrible human life costs. But nonetheless, that will affect your Bloomberg Trading Challenges. And so again, you have to trade in the middle of all this. You can't go to equity. So remember, you can sell short as well as go long. You can also take advantage of mutual funds. Okay. But nonetheless, it's going to be a really tough trading environment over the next week. People try and sort out what's going on globally. Wars don't happen at this scale very often. And obviously, this will be upending the markets, and we're going to have to understand impacts on that. Okay. Somebody has their hand up.
You said you're going to give us the company for homework 6 on Wednesday.
I'll give it to you on Wednesday after we do some practice in class.
Thank you.
All right. Have a good day, everybody. Stay safe out there. See everybody on Wednesday.